Are you sitting on a large capital gain and wondering how to reinvest it wisely, not just for your portfolio, but for the good of the community? Well, there's a powerful and often underused investment tool that might check all of those boxes. It's called an opportunity zone investment, a strategy that blends tax efficiency with the social impact. And in the next few minutes, we're going to unpack exactly how it works, why it matters, and what you need to consider before diving in. So let's get started. What are opportunity zones? First, let's cover the basics. Opportunity zones are specific, geographically defined areas that have been identified by state governors and certified by the U.S. Department of the Treasury. These are areas, typically low-income, census-tract, places where the economy could use a boost, where jobs are scarce, and where access to capital has historically been limited. The idea behind opportunity zones is simple, yet powerful. Let's encourage private investments in these underserved communities, not through government grants or handouts, but by offering meaningful tax incentives to investors who are willing to commit long-term capital. There are over 8,700 of these zones spread throughout all 50 states, Washington, D.C., and U.S. territories. They include urban neighborhoods, rural towns, and even industrial zones, each designed to attract capital and create economic momentum. Next, how do you invest in an opportunity zone? Now, you can't just buy a building or open a business in one of these zones and automatically qualify for the tax benefits. To participate, you must invest through what's called a Qualified Opportunity Fund, also known as a QOF. This is a special type of investment vehicle structured as a corporation or partnership and required to hold at least 90% of its assets in a qualified opportunity zone property. This could include real estate, startups, infrastructure projects, or even operating businesses, as long as they are located in one of the designated zones and meet certain eligibility requirements. To gain the tax advantages, you must take capital gains from selling the stocks, real estate, a business, or another investment and reinvest them into a qualified opportunity fund within 180 days of realizing the gain. That's the critical deadline. If you miss the 180-day window, you lose out on the tax benefits. Next, what are the tax incentives by investing in a qualified opportunity zone? So what do you get in return for placing your capital into a qualified opportunity fund? There are three main tax benefits, and together they can be powerful. Let's walk through each one of them one at a time. Number one, tax deferral. When you reinvest capital into a qualified opportunity fund, you get to defer paying taxes on those gains until the earlier of two events, either when you sell the opportunity zone investment or December 31st, 2026, whichever comes first. That means you can potentially keep your money working for you tax deferred till the end of 2026. Let's walk through a simple example of how this works. Let's say you sell stock in July of 2023 and you generate a $200,000 capital gain. You reinvest the entire gain in a QOF by January of 2024 in order to meet the 180-day window. You owe no taxes on the $200,000 gain in 2023. If you hold the QOF investment for 2026, the $200,000 will become taxable on your 2026 return, which is due in 2027. If you sell the QOF investment in 2025, you pay the taxes on the deferred $200,000 in 2025. Tax advantage number two, tax reduction. This benefit has phased out, but it's worth understanding. If you had invested in a QOF before 2022 and held the investment for at least 5 years, you could exclude 10% of the original gain from taxation. If you held it for 7 years, that exclusion increased to 15%. Since we are now in 2025, any new investment wouldn't have time to meet the 5 or 7 year holding requirement before the 2026 deadline. Therefore, both the 10% and the 15% step up in basis are now fully expired for new investors. Benefit number 3, tax elimination on future gains. If you hold your opportunity zone investment for at least 10 years, you can permanently exclude any additional gains from that investment from the federal capital gains tax. Now let me say this again. If your qualified opportunity fund investment appreciates in value over 10 years, you don't pay any capital gain taxes on the growth of that investment. This is a major long-term incentive, especially for investors with high risk tolerance and patient outlook. So what exactly can a qualified opportunity fund invest in? Most commonly, these funds focus on real estate development. Things like apartment buildings, mixed-use projects, commercial spaces, or renovations of blighted properties. Some funds invest in operating businesses such as technology startups, manufacturing plants, or retail ventures based in opportunity zones. The key requirement is that the assets must be located within the designated zone and that the investment creates substantial improvement on new economic activity in that area. This isn't about flipping properties or passive ownership. Funds must actively be developing or operating the assets, often within a clear mission to generate both returns as well as community value. Now let's talk about the other side of the coin, because while tax benefits are compelling, opportunity zone investments aren't for everyone. First, they are often illiquid, long-term investments. You may be tying up your money for 10 years or more, and there are no guarantees of a return. Second, while the zones are meant to encourage economic revitalization, they often come with high risk profiles due to the local economic challenges, lower tenant demand, or infrastructure limitations. Third, qualified opportunity funds vary widely in quality, transparency, and management experience. That's why due diligence is critical. You should evaluate the fund manager's track record, understand the underlying project, and be comfortable with the market dynamics of the opportunity zone itself. And finally, always consult with a tax advisor or financial planner to make sure the strategy aligns with your broader goals and risk tolerance. So who's the ideal investor for an opportunity zone strategy? Generally speaking, it's someone who has realized a large capital gain and wants to defer or reduce their tax liability, has a long-term investment horizon, think 10 years or more, wants to diversify their portfolio with real estate or private equity style assets, and is motivated by the dual return, both financial as well as social. If that's you, this could be an excellent tool in your tax planning toolkit. In summary, opportunity zone investments offer a rare combination of tax benefits and social impact. By reinvesting your capital gains into underserved communities, you not only position yourself for potential long-term tax-free growth, you also help revitalize neighborhoods, create jobs, and stimulate economic change. It's not fit for every investor, but for those who do their homework, manage the risk, and align their investment with their values and timeline, opportunity zones offer a unique, powerful opportunity, one that might just live up to the name. Thanks for watching. If you would like to find out more about opportunity zone funds, please contact us at info@advisormanageportfolios.com. We look forward to speaking to you soon and educating you further. Till next time.